To help you understand what occurred in your portfolio last night, we've got a lot to catch up on and adjustments to make in your portfolio so that you may benefit securely. Welcome to the Altcoin Bull Channel, the most popular crypto educational channel on YouTube. Vladimir Putin earlier said that Russia will not invade Ukraine, and he asked his forces to stop. Within minutes, explosions rang out throughout Ukraine as Russian forces launched a full-scale invasion of the country. Bypassing its border, Russia launched attacks against military objectives. There have been at least 40 deaths among soldiers and civilians since the assault began. US President Joe Biden has stated that Russia will be held accountable and that the United States and its allies would respond to the invasion unitedly and decisively. So what's the plan here? What will this mean for investments like stocks and cryptocurrencies? How can we best invest and secure our financial futures? Let's go over all of this and more. The Russian invasion of Ukraine has been a fear for weeks now. Everyone was unsure if this was a hoax or if Vladimir Putin was just attempting to get in on the action. The markets loathe uncertainty, and that's why this video is going to be heavily focused on cryptocurrency. However, because cryptography is so new, there isn't much of a precedent from which to make conclusions. Look back in history for stock market instances of conflicts and wars affecting the market. Before we discuss the utterly surprising repercussions of conflict on investments, we must first consider the influence Russia and Ukraine have on the world economy. And this is significant because war is horrible for everyone if these two countries are essential actors. It's very awful, and at first look, Russia appears to be enormous with a GDP of $1.7 trillion and a large geographical mass. However, the more you look, the less important it seems. Don't get me wrong, $1.7 trillion is a significant sum, but it isn't the largest ever. The state of Texas, by comparison, has a slightly higher GDP of $1.77 trillion. At $3.1 trillion, California is nearly twice the size of Russia, so Russia is a force to be reckoned with. However, context is always helpful in understanding the whole picture and its significance. Russia also possesses nuclear weapons, which is far more significant than money. So Texas, I think you're out. How would a penalty on Russia affect the global economy, and would investments suffer as a result? According to the New York Times, the impact of a Russian invasion would be negligible compared to the impact of a pandemic. Russia is not a major exporter to other nations, and Russia is terribly inconsequential in the world economy, except for oil and gas. Of course, oil and gas are essential, which is why crude oil prices have risen sharply in the face of 40% inflation in that sector. While this is unfortunate, is it the end of the world? No, most likely not. Then there's Ukraine's economy. What influence would the global economy and our own investments have here? They export various goods and have a GDP of $155 billion, which is rather substantial. But to put things in perspective, that's approximately 3 months' worth of Walmart sales. So at first sight, you could conclude that based on this information, my Bitcoin in stock should be alright. My Bitcoin, for example, has nothing to do with Ukraine or Russia. The problem is one of feeling. Investors are afraid and averse to taking risk anytime there is more uncertainty. Money will flow out of the riskiest assets and into the safer ones. This is why the rise of tech stocks has slowed faster than the rest of the sector, and why crypto, which appears to be unaffected by any of this, has been hit hard. There are a few techniques to see if investors are shifting their investments to safer assets. The 10-year Treasury yield may be found in stocks. You can look up the market capitalization of stablecoins in crypto. This isn't ideal, but the idea is that investors who want to ride out the volatility can exchange their cryptocurrency for a stablecoin tied to the dollar, which they can lend out or hold on the side until things quiet down. So now that we've established that framework, how have investments done in times of turmoil and war in the past? Because once we understand this, we will be able to determine the optimal investments to make in order to earn. Here's how it works. There's a game called the Battle puzzle. When the possibility of war appears to be growing over time, investments have historically depreciated in value during the pre-war period in anticipation of the conflict. When the conflict does break out, though something unexpected happens, stocks and other assets have a tendency to rise in value. So it's as if you've been dreading giving a presentation in front of the class all week. The morning arrives and you're afraid. However, once you're in front of the class, you realize it's not as horrible as you anticipated. The second piece of the war jigsaw is that if the war begins unexpectedly, stocks and other investments will drop in value as a result of the unanticipated occurrences. As a result, the war riddle reveals a great deal about human psychology in our negative framing. We're so desperate to avoid losing money that we'll prepare ourselves for the worst, and there's data to back up this battle riddle. A list of geopolitical events and market reactions may be found here. An unexpected incident like 9/11 caused markets to lose over 5% on the first day and 11.6% overall, yet it only took 31 days for them to recover. The Munich Olympics disaster resulted in a total drawdown of 4.3% and a recovery time of 57 days, while Pearl Harbor was the most significant on the list with a total drawdown of 19.8% and a recovery time of 307 days. All of this is to indicate that the buildup usually has a significant negative impact on pricing. However, when the event occurs, if there is expectation for it, the market reaction isn't always as negative as we might expect. Of course, we're not fortune tellers and can't guarantee anything, but it does provide some comfort. Let's talk about which industry normally do better amid turndowns and uncertainty before we get into crypto-specific methods. Of course, we've previously discussed oil. If you're the son of an oil mogul, you're undoubtedly doing fairly well right now. But what other alternatives do the rest of us have? Bonds are the first and most important. Bonds have earned a negative reputation as a result of stocks' dominance for more than a decade, and bonds often perform inversely to equities. Bonds returned 12% in 2008 and 8% in 2001, 2002, and 2003. So you can call bonds a dinosaur instrument all you want, but they serve a purpose. When things go wrong, we have gold. When things get scary, people like to have something tangible to hold. Gold has risen significantly in the recent week, particularly in the last day. There are also stock sectors that perform better than others. The industries that perform the best are those that deal with items that are difficult to live without. Healthcare, consumer necessities like food, telecommunications, real estate investment trusts, utilities, and of course, defense if you're betting on war. During downturns, luxury goods and entertainment often do not do as well. So what is cryptocurrency and how can we earn from it? Recently, cryptocurrency has had a difficult time. Every other week, China attempts to outlaw it. A study equating cryptocurrency to Ponzi schemes was released by Russia's central bank, prompting a ban across the country. But it turns out that's not how they felt, since they're not considering inventing their own cryptocurrency, particularly now that they've chosen to begin a war with the rest of the world. They may also be barred from using the SWIFT financial system, which enables bank-to-bank transfers. As a result, they've developed an interest in cryptocurrency. I'm not sure. Then there's the issue of interest rates and the fact that when rates rise, investment becomes more expensive and investors are less inclined to invest in riskier assets like crypto and overvalued stocks, which may lead to price declines. Then there's the possibility of crypto-related restrictions in the United States, which might hinder innovation. It's as if crypto can't seem to get a break every month or when anything happens to knock it down. But you know what I really enjoy? It simply continues pressing forward, getting slammed down, brushing itself up, and skimming its way back up. It's a little like Rocky getting knocked down by that big Russian guy over and over again. But what counts most is that crypto usage is expanding. Total value locked in DeFi is increasing, and institutional investors are becoming more comfortable with digital assets on their balance sheets. Now, given what we know, Let's discuss profit strategies. The first and most obvious option is to simply purchase the dip. Of course, when you're saying, yeah, I got the dip in December and see how that turned out, is easier said than done. The key here is to always keep some extra cash on hand for future dip purchasing chances. Then you're never fully committed. During this lump, my plan is to concentrate on the major Layer 1 crypto projects that I am most interested in. I believe that now is not the time to invest in the tiniest cryptocurrencies. There's simply too much turbulence. As a result, my purchasers have concentrated on the top 10 range developments that have a large number of projects developed on top of them for greater diversity. Then on top of that, I've been employing various low-risk tactics. I've just been doing it for weeks. Spot futures arbitrage bots are what they're called. This may be done with Pionex, which I'll link in the explanation. Essentially, this is a bot that buys both a long and short position in a cryptocurrency and then earns a financing fee. What's great about this is that you can profit in any market with almost little danger of volatility. It appears to pay between 5% and 10% APR during downturns. Then when the market recovers, you can profit by as much as 50% or more. Beyond that, there's always stablecoin lending, which is one of my favorite elements of cryptocurrency in general. I mean, is there anything better than checking your account in the morning to realize you've made a few bucks doing nothing? Because I do the majority of my lending on KuCoin and I'm most familiar with how they operate. This may differ slightly depending on which side you use. But KuCoin adds an extra degree of security by providing an insurance fund. So if you earned $100 by lending out USDT, $5 would go to KuCoin and $10 would go to an insurance fund. This fund guarantees that you be paid regardless of the borrower's ability to pay. And while I've gone through hundreds of transactions on my KuCoin app and have never seen the insurance fund used, it does provide a nice little peace of mind. I've been using KuCoin for approximately 9 months and have generated over $24,000 in profit just from lending, with no danger of volatility. I'll also link to them in the description, and that link will save you some money on trading costs. Or you can take the DeFi lending route and lend out something like UST for a decent interest rate. However, keep in mind that this will not be held on an exchange, so there will be a few more procedures if you want to fast transfer it and purchase the dip. Now I'd want to leave you with one final thought. Whatever happens in Russia and the markets, it's always a good idea to attempt to keep emotions in check. The news will try to raise those feelings, but it will also try to keep them down. Set your long-term focus and invest properly rather than freaking out over the news. Once again, this is the Altcoin Bull Channel, bringing you the best and most updated news and trends in the crypto world. If you like the video, don't forget to subscribe and hit the notification bell. Thank you and see you in the next one.